Two traders, same markets, same charts, same information available to both of them at exactly the same time. One of them is consistently profitable. Not every week, not every session, but over time, across hundreds of trades, the account grows. The losses are real but contained. The wins are real and compounding. And the trader behind the screen maintains a steadiness that doesn't rise too much when things are going well, or fall too far when they aren't. The other trader has almost identical technical knowledge. They can read price action. They understand support and resistance. They know what a good setup looks like. They've studied the same material, followed the same frameworks, learned the same patterns. And yet the account tells a different story. Weeks of gains erased in a single session. Rules followed until they weren't. A pattern of almost profitable, almost consistent, almost there, that repeats month after month without ever fully resolving. The gap between these two traders is not strategy. It is not market knowledge. It is not intelligence or work ethic or access to information. It's psychology. It's the difference in how each trader thinks about the market, about losses, about their own role in the outcome, and how those differences in thinking produce completely different behaviors under the exact same conditions. Today we're going through 7 specific psychological contrasts between the winning trader and the losing trader. Not as a judgment, but as a map. Because if you can see clearly where the losing patterns live, you can start replacing them with the ones that actually compound. The first and most fundamental difference between the winning trader and the losing trader is not how often they lose. It's what they do with it when they do. The losing trader experiences a loss as a verdict. The trade failed, which means something went wrong, which means the analysis was incorrect, which means a problem needs to be solved immediately. The emotional response is proportional to the perceived severity of that verdict, and it drives the behavior that follows. Another trade to fix it. A position held too long, hoping it comes back. A session that starts with a manageable stop-out and ends somewhere much worse. The winning trader experiences a loss as a data point, not a comfortable one. Losses sting, regardless of how psychologically healthy your relationship with them is. But a data point. One of the losing trades the system expected to have. Something to be logged, reviewed, and extracted from. Not responded to emotionally in real time. This difference in loss processing isn't innate, it's developed. It comes from a deep internalization of what trading actually is. A probability game played across hundreds of outcomes, where no single trade carries enough weight to justify an emotional response that affects the next one. The winning trader has done enough work, journaling, reviewing, tracking, to genuinely believe this. Not just to say it, to believe it at the level where it governs behavior under pressure. The losing trader knows it intellectually. The winning trader knows it experientially. And that gap, between knowing something and having it change how you actually behave, is the difference that shows up in the account. The losing trader is always searching for the edge, the next strategy, the next indicator, the next approach that finally produces consistency. When results are poor, the conclusion is almost always that the current strategy isn't working, and the solution is to find a better one. This produces a cycle of constant strategy rotation that never allows any single approach to be tested across enough trades to reveal its true performance characteristics. The strategy changes before the data is complete. The sample is always too small to be meaningful, and the trader is perpetually starting over. The winning trader already has an edge. They found it through backtesting, through real money testing, through the careful, patient accumulation of performance data across countless trades. They know their win rate. They know their average risk-reward. They know which market conditions their strategy thrives in and which ones it struggles with. And because they know these things with genuine confidence, they don't abandon the strategy when it underperforms for a session, or a week, or even a month. They know the difference between a strategy that isn't working and a strategy that is working through a normal losing variance period. And that distinction is everything. This isn't blind faith. It's evidence-based conviction. The winning trader trusts their edge because they have proof of it, not because they believe in it emotionally. And that evidence-based trust is what allows them to keep executing through drawdowns that would cause the losing trader to switch strategies and reset the sample all over again. The losing trader has conflict with their rules. This is important to say clearly. Because the losing trader is not someone who never learned discipline or never built a trading plan, most losing traders have rules. The problem is the relationship they have with those rules under pressure. When conditions are normal, when the account is flat, when there's no emotional charge in the session, the rules hold. The losing trader follows their plan, takes valid setups, and manages risk appropriately. The system works in calm conditions because calm conditions don't test it. But when a loss hits, or a streak builds, or a setup appears that doesn't quite qualify but looks compelling, the rules become negotiable. Not abandoned outright, negotiated. Just this once. The setup is close enough. I'll tighten the stop later. Each negotiation has a justification that sounds almost reasonable. And each one erodes the system a little further until the rules exist only on paper, and the actual trading is running on real-time emotional judgment. The winning trader's rules are non-negotiable. Not because they're a more disciplined person by nature, but because they've done the work to make the rules structural rather than voluntary. The daily loss limit isn't something they decide to honor in the moment. It was decided before the session started, when their head was clear. The entry criteria aren't evaluated under live market conditions. They were written before the open, in enough detail that the trade either qualifies or it doesn't. The winning trader has removed as many in-the-moment decisions as possible, because they understand that in-the-moment decisions, under live market conditions with real money moving, are the decisions most likely to be made emotionally rather than logically. The losing trader measures success by the outcome of individual trades. A winning trade is a good day. A losing trade is a bad day. The P&L number at the end of the session is the verdict on how well they performed, and by extension, on how good a trader they are. This creates a direct line between the account balance and the trader's sense of self-worth. When the account is up, they feel like a good trader. When it's down, they feel like a bad one. And that emotional volatility mirrors the account's volatility, because the two are directly connected. The winning trader measures success by the quality of their process. A losing trade taken on a valid setup, at the right size, with the stop in the right place. That is a successful trade regardless of outcome. The process was correct. The outcome was variance. A winning trade taken on a marginal setup, size too large, with a stop that was moved. That is a failed trade regardless of whether it made money. The process was wrong. The profit was luck. And luck doesn't compound. This shift, from outcome-based measurement to process-based measurement, is one of the most important transitions a trader makes on the way from losing to winning. It decouples the trader's psychology from the daily P&L in a way that makes consistent execution possible. Because consistent execution requires emotional stability. And emotional stability, when it's tied to daily outcomes in a probabilistic system, is impossible to maintain. Tied to process quality, it becomes achievable. Because process quality is something the trader actually controls. The losing trader's relationship with trading exists almost entirely inside market hours. The session opens, they trade. The session closes, they're done. Maybe they look at the charts occasionally during the evening. Maybe they follow market news. But the structured, deliberate work of improvement happens rarely, if at all. And because no systematic improvement work is happening, the same patterns repeat. The same emotional responses. The same rule violations under pressure. the same results. The winning trader treats the time outside the market as the most important part of their trading career. The post-session journal review. The weekly performance analysis separating valid losses from poor entries. The backtesting of new ideas before they're traded with real money. The pre-market preparation that puts the brain in the right state before the open. The ongoing work on emotional regulation. Understanding their specific triggers, their personal tilt patterns, the conditions that reliably compromise their execution. This is the off-season work we covered in the athlete video. The preparation that no one sees and that determines everything about what's possible when the market opens. The winning trader's edge isn't just in their strategy. It's in the compounding improvement that comes from treating every closed session as data and every piece of data as an opportunity to become slightly better. The losing trader waits for the market to teach them. The winning trader extracts the lesson before the next session starts. The losing trader thinks in terms of individual trades. This trade will work. This setup is going to hit. This entry is the right call. Every position carries an expectation, not a probability, an expectation. And when the expectation isn't met, the emotional response is frustration, confusion, and the need to correct a wrong. The winning trader thinks in terms of sample sizes. Any individual trade can go either way, and the winning trader genuinely, not just intellectually, accepts that. What they're not indifferent to is the aggregate. Over 100 trades, their edge produces a specific outcome. Over 500 trades, that outcome becomes statistically reliable. The goal is not to win this trade. The goal is to execute this trade correctly, as one instance in a large series of correctly executed trades that produce a positive expected value over time. This shift from trade-by-trade thinking to sample size thinking is what allows the winning trader to take a loss on a perfect setup and immediately be fully ready for the next one. The loss didn't change anything about the series. It was one data point. The series continues. There's a concept in statistics called the law of large numbers. The principle that as the sample size grows, the observed outcome converges on the true probability. A coin that flips heads 50% of the time will show that result clearly across 1,000 flips. But across 10 flips, anything can happen. The losing trader is living in the 10-flip world, drawing conclusions from samples too small to be meaningful. The winning trader is living in the 1,000-flip world, trusting the expected value to reveal itself across a sample large enough to prove it. The last contrast is the deepest one, and it's the one that underlies every other difference on this list. The losing trader has a fixed relationship with their own ability. They are either good at trading or they aren't. When things go well, the identity is confirmed. When things go badly, the identity is threatened. And because the identity is tied to the outcome rather than the process, every losing streak becomes an existential question rather than a performance problem with a performance solution. This is what psychologist Carol Dweck calls a fixed mindset. The belief that ability is a static trait you have to a certain degree rather than a dynamic capacity that develops through deliberate effort. In trading, the fixed mindset manifests as a trader who either feels like a natural or feels like a fraud, depending entirely on recent results. Who abandon strategies when they don't work immediately, because poor performance is evidence of permanent limitation rather than a stage of development. Who resists honest self-assessment, because seeing the flaws in their process threatens the identity rather than informing the improvement. The winning trader operates from a growth mindset, the understanding that trading ability is not fixed, that every skill involved in consistent trading can be learned and improved, and that current performance is a starting point for development rather than a verdict on potential. This mindset doesn't make losing easier, but it changes what losing means. A losing streak is a problem to be understood and solved, not evidence of permanent inadequacy. A pattern of emotional trading is a habit to be replaced with a better one, not a character flaw that can't be changed. Every gap between current performance and desired performance is simply a gap, and gaps close with the right kind of work. This is the psychological foundation that makes every other contrast on this list possible. Without it, the tools don't hold. The rules bend. The process erodes. Because underneath the specific trading behaviors is a story the trader tells themselves about who they are. And that story either makes growth possible or prevents it. The winning trader and the losing trader are not different people. In most cases, they are the same person, at different stages of the same journey, or in different sessions of the same week. Every trader who eventually becomes consistently profitable spends time operating from the losing trader's psychology first. The loss as verdict. The rules that bend. The outcome-based measurement that tied their sense of self to a number that moves every day. The strategy rotation that never allowed any approach to be properly tested. The fixed story about what they were capable of. What changed, what always changes for the traders who break through, was not the strategy. It was the psychology. The gradual, deliberate, sometimes painfully slow shift in how they thought about losses, about their edge, about their rules, about success, about time outside the market, about probability, and about themselves. None of the 7 contrasts in this video represent a destination. They represent a direction. A trader who recognizes the losing pattern in themselves and begins moving, even slightly, even imperfectly, toward the winning one, is already doing the most important work available to them. The market will keep opening. The question is, which trader shows up to it?